Hi guys, welcome to my video about Fibonacci retracement levels. I want to do a video just directly based on Fibonacci levels because I think there's a little bit of confusion. Some people naturally assume that maybe the 61.8 is the only ratio they should be going from. And a lot of people don't understand, like, for example, the importance of 78.6 or how really each Fibonacci level is, it has the same importance as any other Fibonacci level. So I've covered this, I believe, in market patterns and rules on the video where I explain about, waiting for price to stop. The first thing that we do is apply a fib, and then we're anticipating price to come down to one of our fib ratios, and how we can basically use different conferences such as previous market structure or trend lines to try and determine where we think price is going to go to, which ratio is going to go to. So every single trade is different. Every single trade is individual, and every single trade will not always go to the 61.8, or it will not always go to the 50 or the 38.2. So I just want to do a little bit of like an overview of what a Fibonacci tool is. So obviously we have the 0% and we have the 100%. Now what we do is once price has stopped, if it's a bullish fib, we draw it from the recent swing low to the swing high to try and anticipate our retracement and to then take it to go long. And again with the bearish fib, we go from the recent swing high to the swing low to then try and find a retracement then to go short. So how this works is generally when we come off one of these fib levels, what we would do is we always target the 0% first to take off a percentage of our profit, and then we aim to try, if we can, to hit the fib extensions at minus 27%, and obviously then minus 618% if we can get it. Now, generally speaking, if you're applying the fib on the smaller time frames, such as the 1 hour or the 4 hour, it's very likely that you will hit the minus 618. So therefore, you should try and hold the trade for as long as possible. But if you're using the fib tool on a larger swing, such as the weekly or the daily time frame, the fib extension targets, especially the minus 618, is quite unrealistic because it's quite a large target. So therefore, in that scenario, I would probably only try and aim for the minus 27%. Now, what happens is with a bullish fib, when it comes up like this, obviously you're anticipating for it to come down to one of these levels, and it will come down to the level where it's got the most confluences. So say, for example, in this scenario, it comes down to the 61.8, and then price hopefully will come up to the minus 27%. And then if it's a smaller fib, it's very likely it will come up to the minus 618. So say, for example, you go long here, and then you've watched the entries video and you've got a tight entry, you've placed your stop below the first wick. What I would suggest for you guys to do is to take off maybe 30% of your profit at the 0%, just in case price comes up, forms a double top, and then obviously rolls over and breaks this recent high low and then begins a bearish sequence. At least that way you've got some kind of reward out of it. So I would suggest taking 30% off here and then trying to target the minus 27%. And obviously if this is a smaller fib, then to try and target the minus 618. Now again, that's the same with this. What I would do is, in this scenario here, you'd go from the recent swing high to low. You're looking for a retracement to one of these levels. Say, for example, on this occasion, it's the 50%. And therefore, you would go short here, placing stops once you've scaled in above the first wick. And then again, you'd be taking 30% of your trade off here, just in case you form a double bottom, or just in case you break, you form this double bottom, then you come up and actually begin to look bullish. So talking about Fibonacci levels and rules, there are some adaptations that I've seen some traders do to the Fibonacci tool. So for example, they've put a level between the 61.8 and the 78.6. Now, the thing is, and the problem is with this, is that retail traders only make up around 6% of the actual financial market. The rest of the market is made up by banks who use technical analysis tools, and they don't tend to kind of adapt the Fibonacci tool at all. Now, if we were to place a level between the 618 and the 78.6, then we may as well go ahead and place a level between the 50 and the 618. And then we may as well place a 50% between the 38 and the 50 and place one between here. And then before we know it, we've got around sort of 12 fib levels, and that's not going to benefit us at all. So therefore, it's in our best interest to stick to the actual Fibonacci tools that banks and institutions use, because we want to learn how to trade like a bank and an institution, as opposed to trading like a retail trader which 70% of those people obviously blow their accounts and lose their money. So we want to learn how to trade by the guys who are actually using these tools, and they're using the actual Fibonacci numbers. Now, the actual 50% is not an actual real Fibonacci ratio, but it does have its place within the market. Institutions tend to use this level a lot because it's obviously half of any move, so therefore it makes logical sense. And it also works really well with commodities such as gold and oil, silver. 50% is very well respected in those scenarios. But we want to use only the Fib rules. Now, Fibonacci was developed hundreds of years ago. It's actually been seen within Indian mathematics thousands of years ago, and it was picked up by an Italian mathematician around sort of 800 years ago by a guy called Leonardo Fibonacci, who basically used a number sequence to figure out some sort of mating within rabbits. So it's something that's been used very frequently. They say the 61.8 is the golden ratio, and that is true. But with that being said, these Fib ratios have equally just as much importance as the other one. The 38.2 is just as important as the 50. The 618 is just as important as the 78.6. And we should stick with these levels. And like I said, depending on other confluences, price can go to any one of these levels. No particular Fib ratio is favored. Now, what you'll normally get with high momentum trades, which is what I've covered in bear and bull flags, it doesn't necessarily have to be a bear and bull flag, but generally speaking, when you get a high momentum move, quite a steep move to the upside, with no real pause or resting phase, generally you'll only get a slight shallow retracement to the 38.2 for then a continuation. So the 38.2 works very well with break and retests and high momentum shallow retracements. The 50 is more of an institutional level. It's not something that's respected as much. And then you've obviously got your 61.8 and your 78.6. Now, people underestimate the importance of the 78.6. It's something that's very much overlooked. Now, the 78.6 can be used through multiple ways. And it can actually be used as the last point before invalidation. So therefore, if this is a 4-hour Fib, if you get 4-hour price action, which closes below the 78.6, then this Fib is entirely invalid. So therefore, its extension targets, etc., would be invalid. And therefore, the next point you would look would be the 0%, which is this point here. And then obviously, if you break below this, then the entire bullish sequence has changed. And therefore, you would be deleting this Fib. And then you'd actually be putting your Fib the other way round. So then look for a retracement. And then you'd be going into a bearish Fib. But generally speaking, the 78.6 is invalidation. Now, if you do get a close below like this, so say for example, this is a 4-hour Fib, and you get an hourly close below the 78.6, you may get a couple of hourly closes below this, but as long as the 4-hour actually closes above, it's still very much valid. And that works with daily Fibs too. So, you know, as long as you don't get like a close below the 78.6 on a daily Fib, then it's still valid. You know, you can get 4-hour and 1-hour closures and spikes and things like that. And that's obviously what produces the wick on the higher time frames, right? So the wick always shows you where price has been, but the body closure will always show you where price then closed. So if this is a 1-hour Fib, you can have 15-minute closures below. 4-hour, you can have hourly closes, etc. But this is very much still intact, as long as you don't get, like, say, a daily close on a daily Fib. So the 78.6, we can use this as a point of invalidation. So generally speaking, what people will do is if they're coming off the 61.8, most people will put their stops below the 78.6 because they know that the 78.6 is the last point of invalidation. But the problem is that if they're coming off the 50 or the 38.2, they don't know where to put their stops. And this is why we don't use this theory within the course of simply coming off the 618 every time and then just simply putting our stops below the 78.6. It's very generic and it doesn't work in all situations. So therefore, we look to come off any of these Fibs because we know that each Fib is equally just as important as the other Fibs. And we use the scaling in technique to find our stop losses as opposed to using another Fib ratio as our stop loss. So therefore, if this was a 4-hour Fib and we were approaching the 50%, and the 50% had multiple layers of confluences, therefore we'd be scaling down to the 1 hour, looking for the tap, using the first tap as benchmarks for stops, and not actually using any other Fib ratios as our benchmarks for stops. And it's the same with the 61.8. If we can have a stop loss here, as opposed to having it here, then that would provide a much better risk to reward. So the best way of using the 78.6 with regards to invalidation is actually for things like lower highs and lower lows. You can use it to anticipate lower highs and lower lows. So if, say for example, this was coming up like this, and this was a bullish sequence, we know that if price breaks below the 78.6, then it may close below here. So then we'd be looking at and treating this as potential a bearish turnaround. So we can use the 78.6 as the last point of invalidation to help us create and anticipate new lower lows or lower highs, etc. So it's a really, really good point. And just remember, if you get the close below it or above it on the bearish example, then that is complete invalidation. So now you understand the actual fib ratios and how each one is equally just as important as the other, and you understand the history behind it, there should be no reason to actually tamper with these levels. You need to just be using these levels. Don't alter it. Don't put levels between it, because the banks aren't doing that, and the banks don't know the people that are doing that. So we need to be using the tools that they're using. Now, I just want to go into some examples of basically how we can use bullish fibs within the larger bearish fib. So what I mean by that is, if we're going on the higher time frame and we've applied our fib tool, so say for example in that scenario it's a bearish fib tool, we can actually use smaller bullish fibs within the larger bearish fib to try and find an overall bearish target. So therefore we could potentially counter trend trade the actual pair that we're on until it finally gets to that overall bearish target. Now, I wouldn't suggest using any confidences by themselves. We never, ever want to use just a candlestick, just a fib ratio, just the touch of a trend line. The idea is to use multiple confidences together in harmony to try and almost predetermine areas of interest, so that way when we get to those areas of interest, we know how to execute by scaling in. So I'm just going to show you some examples of this. Now, this is obviously a downward movement. We're in a bearish sequence. Now we've had one tap, two tap, which has allowed us to draw this trend line. Okay, so kind of just imagine for a second this isn't here. Now you can see here that we wouldn't have done this, but this did hit the 78.6 and then it came down to create this lower low around the minus 27%. So at this point here, when we create this point, this point, this point, and this point, we had two touches, so therefore we had two low highs and two lower lows. So therefore we would have been anticipating the third lower high. So what we would have done when price stopped here is we would have applied our fib from here to the swing low, and we would be anticipating for the fact that price was probably going to come up to the 61.8 for a third touch for us to sell it within this bearish sequence. Now, what I mean by using bullish fibs, smaller bullish fibs, or maybe the smaller time frames. So say for example this is a daily time frame, this would be maybe a 4-hour fib. What we can do is we can use a bullish fib within a bearish fib to try and find an extra confirmation for the overall target. So you can see here that we came up, we stopped here, we came down, we hit the 61.8%, so we could have actually bought it here as a counter trend trade, and we would have seen that the minus 27% lined up with the 50% of the overall target, and the minus 61.8% lines up with the 61.8% of the overall target. So we've got this double layer of confluence. So we could have bought it here and sold it here. So you can see how we're getting this overlap of confluences. So therefore you can take these small intraday trades where they might be against the trend, but you're taking them because you've got that kind of validation that when it does get to this point here, you are then going to be selling it. So I want to show you some examples of this actually in live so that you can see almost what I'm talking about. So with Euro USD here, price came down. Now overall on the higher time frame, we're currently on the 4-hour, but on the daily we are producing lower highs and lower lows, as you can see here, right? So we knew that really, although we took out this here, and the grand scheme of things, we're bearish. We've made that choice. So now price has stopped. The first thing that we want to do is apply a fib. Now this is quite a large fib, and we're looking for price to pop up to maybe the 50, the 618, the 78.6, knowing that the 78.6, if we break above that, then we could be going higher and actually invalidating this entire bearish sequence, because we know that the 78.6 is complete invalidation. Now we can also see something here at the bottom, which I've shown in one of the other videos, where we've actually got an inverse head and shoulders. Now an inverse head and shoulders is a reversal pattern, but it doesn't necessarily mean it's going to change the overall trend. It's just temporary. So this is where I talk about making your decision on a higher time frame, sticking to it and not getting too confused when you begin to see bullish price action, which is temporary, when actually we're still within a bearish sequence. So we could have used this pattern and traded this as a bullish pattern temporarily. And if we mark this here, we could have come off the 61.8 here and bought this, and our targets for this particular pattern actually lines up with the overall bearish pattern. Can you see how the targets for this bullish pattern lines up with the overall bearish target? Now, this is giving us confirmation that this could be our new lower high. So we're trading it temporarily as bullish, and then when it gets here, we'd look to place some shorts for the bigger picture. So let's just play this out and see how it plays out. So this inverse head and shoulders was a great rules criteria pattern. The left shoulders equal moves to the right. Now, even when we've got this here as well, we can also, now we've got one tap, two tap, which is the head and the right shoulder. We can actually apply a trend line like this as well. Now, as we approach the 50%, we reject it, which is what we expected because it is duplication. And at this point, on the bigger time frames, we can begin to think that we may roll over. Now we had one tap, two tap, three opportunities to short this around the 50%. And then obviously we broke this trend line, which is really a counter trend line. And then we basically came down to form a new lower low, which is what we anticipated anyway, because we are in a bearish sequence. But you can see how we used a bullish pattern to determine the overall bearish target. So this is one example. This is another example here. Again, it's a pattern to help us define the overall bearish target. Now, this is Euro NZD. We were creating lower lows, lower highs. So this was our recent lower low here, and then we formed this new lower low, new lower high. So we're anticipating for price to come up and basically form a new lower high, in which case we would be selling this. Now, for extra confirmation, I can see that we are potentially developing an inverse head and shoulders, which is a bullish price action, but it's only temporary bullish. We can use this to define the overall target. So therefore, I would cap off what I believe could be a potential neckline if price comes up to tap here. I can cap off the left shoulder, something like this. And then I can use a bullish fib within an overall bearish fib. And I'd be looking to place a counter trend trade at rejection of the right shoulder. And you can see for targets from head to neck, I can get my overall bearish target. So I can trade it here long as a bullish trade, which is a counter trend trade. And I can trade it up to the bearish target, the overall bearish target, and then sell it again. So buy it from here, sell it from here, and use this temporary bullish fib to help me find the overall bearish fib. So let's just play this out and see what happened. So we come up and tap the moving average, came down, formed a base at equal movements of the left shoulder, came up and hit duplication of the head to the neck, which then gave us our overall target of the bearish. So we could have bought it here, sold it here. There's another example here with NJ. So we form 1, 2 tap, which allows us to draw a trend line. We've now placed our fib from the recent swing high to the swing low because this is a bearish fib, because we actually broke these recent higher lows and formed this new lower low. And now we're anticipating price to probably come up to around the 61.8, something like that. We've obviously got our daily 50 moving average here as well, so this looks like quite a nice zone to sell from. And we have previous market structure here. Now, if we zone down, we can actually use a bullish fib on this to find the overall bearish target. So let's go down to the 1 hour. In fact, let's go to the 2 hour just to make this nice and clear. Now, if we look at this, we can see that we have a fib, a bullish fib, from this level here to here. Now we've tapped the 38.2 here. And now we can see that really our minus 27%, so if we just zone out here, we can see our minus 27% of the bullish fib and the minus 618 of the bullish fib lines up quite well with our overall targets of the bearish fib, which is the 61.8 here and the 50%. So they're kind of like overlapping. So therefore, we can now place a zone here, and we can place a zone here. So these are our two potential targets for this to retrace to on the overall fib. So let's remove this bullish fib. So we could have gone along from the 38.2 to target the minus 27% or the minus 618. So now by using that temporary smaller bullish fib, we've now given ourselves some extra confirmations for these levels to be hit. So that's another example there. Now I'm going to show you another example here on Euro NZD. Now we had this huge move to the downside. It began on the 8th of October 2018 and finally finished around the 5th of December. It was a 2-month move to the downside. Very large move. It was around 1,600 pips nearly. Now, when price finally showed us that it stopped, we could have placed an overall fib within this. This is our bearish fib. Now we can see it did come up to tap the 50%. But we could have traded this leg on the way up to that point using bullish fibs. So we could have done a counter trend trade and actually traded this all the way up to the larger bearish fib. So if we scale down to this, we just go back. There's opportunities here to trade it as a bullish. So what happened was we formed this point here and then this point here, so that's 2 points. Allows us to draw a trend line. Price stops from here to here. Allows us to draw a fib. We bounce off the 618, we hit target 1, target 2. And then what actually happened here is when we began to approach the 50%, which is here, we actually started forming this head and shoulders pattern. So what I'm trying to say is we could have traded this bullish price action on the smaller time frames and just been consciously aware of the fact that we could be approaching an overall bearish target, which is what we did here. We hit the 50% of the overall move, and then obviously we sold off again. So there's some examples there. Now, I just want to show you one more thing, and that's with this here. Now, somebody asked me a really great question the other day about when fibs are valid, when they're not valid, what would you do? Now, let's talk about this here. So we've got one move up here, allows us to draw a trend line once we've got this point and this point. Now, price comes up to here and stops, so therefore we can draw a fib. Price bounces off the 50% and hits the minus 27%. And then we do it all over again, okay? We draw a fib from here to here. Price is meant to come down and hit maybe the 50 or the 618, but it doesn't do that. It breaks. And it breaks this trend line. So therefore, the moment it breaks this trend line, the first thing we have to do once price shows us that it stopped is we apply a fib like this, and then we're anticipating price to come up, retest, hopefully one of our fib levels, and then roll over. But somebody said to me the other day, what do I do if price comes up and breaks straight through? See, this is where we have to then scale down to see if price is respecting this level. We don't want to just jump straight in the moment it hits the fib or the moment it just produces one candlestick. We're looking for a couple of candlesticks. So if this is a 4-hour time frame, we'd be going down to the hourly. We'd be looking for a couple of candlesticks to confirm that it is respecting the level. Can't just jump straight in or put a sell limit in. And if it doesn't do that and it breaks back above this, then we know that this break was a fake break. And in which case, what you would do is you would delete this fib. You'd go back to this fib. You'd see that actually it hit the 78.6. So now what you would do is you would delete this. And now you would connect these 2 points up here. And then what would probably happen here is then you would resume normal bullish behavior. And you'd come up and create this new higher high. And then you'd fib this. So then you'd fib this. Like that. And then you do it all over again, 618, etc. And that's how quick things can change. Obviously, once it breaks a trend line, if it flicks back up above the trend line, then you know that the bearish fib that you just applied is invalid and you have to apply the original fib. And it's likely that because 78.6 is the last point of invalidation, maybe it came down to hit that. It didn't break overall market structure. So therefore, this is how quick you have to adapt into the market. Okay, so just bear that in mind when you're using your fib levels. So I hope this has been helpful, explaining about the fib ratios, not to tamper with them, not to put extra levels in, and to only use the fib levels that the big boys are using, such as the institutions and the banks, and how you can basically use temporary bullish fibs on smaller time frames to get the overall bearish target on the higher time frames, or the other way around, how you can use temporary bearish fibs on the smaller time frames to get the overall bullish target. So I hope that's been helpful. And if you've got any questions about this, you're more than welcome to get in touch.